How to determine exactly what loan amount you qualify for. That's what we're going to cover today. My name is Samuel Johnny. I manage the Southwest Funding Office in Southfield, Michigan. I'm right off of 12 Mile and Telegraph in the Onyx building. I financed over 100 homes for families and individuals, help even more refinance their current properties. And I do these videos as a way to educate current homeowners and potential home buyers as to the current events and just keep everyone abreast with what's going on in the mortgage industry and ultimately educate you on how to purchase a home. So today we're going to cover how to find out exactly what loan amount you qualify for. That's what everyone wants to know when they call me or reach out to me via email. So I'm going to tell you all or educate you all exactly on what I look for and how I calculate your debt to income ratio, your gross income, and how I go through the steps to decide exactly what loan amount you qualify for before I write up your pre-approval, okay? So the first thing I want you all to do is find out what your gross income is, all right? The easiest way to do it is just looking at your 2016 W-2, all right? So your gross income is the income that you made over the year, over the full year, 12-month calendar year, without taking out any taxes, okay? So it's not your take-home pay, it's your gross pay. So last year, let's say you made $5,000 a month gross. That means that your gross annual income is going to be $60,000, all right? So that's what we're going to do. We're going to use $60,000 as our gross annual income, and that's going to give us $5,000 a month. All right. So we have $5,000 a month as our gross monthly income. How much home will you qualify for? Okay. People always ask me that. They say, okay, I make $6,000 a month. How much home can I get? Well, that depends on what your debt to income ratio is, okay? If you make $8,000 a month, but your bills reporting on your credit report are $5,000 a month, well, you don't necessarily make $8,000 a month, if that makes sense. You pay $5,000 a month, and you have $3,000 a month left. So now we have to work based on that $3,000 and not based on the $8,000 that you make. So the main thing that you want to do is find out what your liabilities are. The easiest way to find out what your liabilities are is to look at your credit report. When you look at your credit report, it's going to give you a running tally of every liability that you have. And then next to that liability, it's going to have the minimum payment due every month. So go to creditkarma.com. Look at your credit report on there. It's not accurate as far as your credit score, but your credit report is going to be accurate. Don't pay attention too much to the credit score. The credit score is going to give you a ballpark figure of what your credit score is. It may be 40 points off, higher or lower, but as far as your credit report, that's accurate. So it'll give you a TransUnion report and I think one other credit report from either Equifax or Experian. But you're going to look at that credit report, okay? When you're looking at that credit report, you're going to look at all of your liabilities to see exactly what you're paying, the minimum payment next to each one of those liabilities. We're not looking to see what your cell phone bill is because that's not going to report in your credit. We're not looking to see what your cable bill is. That's not reporting on your credit. What I'm looking at is your credit report, and I'm going to see exactly what all of your monthly liabilities are and what the payments are, the minimum payments on those monthly liabilities. If you're paying more towards your credit card, that's fine, but I'm looking at the minimums, okay? So for all intents and purposes, let's assume that you make $5,000 a month and your bills on your credit report are $1,000, okay? So you have $1,000 in liabilities, all right? So this is your gross income, and these are your liabilities, all right? All right, so gross income liabilities, okay? So your liabilities may be, car, credit card. Then you may have, some student loans or any other type of private installment loans. So student loans or installment loans. All right, so you have $5,000 as a gross income. You have, I hope you all can see this, my handwriting is horrible. But you have $5,000 in gross income. You have $1,000 in monthly liabilities, okay? And now you have, your car note, credit card, student loans, installment loans. So when you're talking about liabilities, you're looking at revolving debts. So you're looking at credit cards, those are revolving debts, and you're looking at installments. So installments are set payments. So like a student loan is an installment, or a car note is an installment, 60 months, 48 months, however long you have the term for. But those are installments. So we're looking at installments and we're looking at revolving debt like credit cards, open lines of credit. So $5,000 a month is your gross income. Okay, this is a $60,000 a year borrower. And then we have $1,000 in payments that are reporting on your credit report, not what you're paying as far as utilities or anything like that. $1,000 on your credit report. So find your credit report, add up what the minimum payments are, and then you want to divide that by your gross income. That's how you do it. All right, so if we're looking at this and we need to find out exactly how much home we qualify for, we need to find out what loan program we qualify for first and foremost. Most loan programs now, actually all of them, even conventional loans, they allow you to go up to 50% of your debt to income ratio. That change just came out this month, I think. So for Fannie Mae loans, you're allowed to go up to 50% of your gross monthly income. So if you make $5,000 a month, 50% is going to be $2,500. So as long as you don't exceed $2,500, you're good to go. So that means that $1,000 is already taken out of this $2,500. So you have $1,500 left for your housing expense ratio. So if we're looking at $5,000 a month and we have $2,500 because we can get an FHA loan at a 50% on our debt to income ratio, we can get a conventional loan now on a 50% debt to income ratio. We can get VA. The only loan I don't think will go up to 50% on a DTI is a USDA loan, so a farm loan. I've done one of those in the last 5-6 years. So in most cases, it's VA, conventional, or FHA for most people. But all of those allow you to use half of your gross monthly income. Okay, so if they allow you to use half of your gross monthly income for your housing expenses and all of your current liabilities are $1,000. Now you're looking at a situation where, you know, your liabilities are $1,000. You take the $1,000 out of this, so now you have $1,500 for a mortgage payment. All right. So how much home can you get for $1,500? Well, I generally tell people you're going to be looking at around $800 per every $100,000 if we're looking at an FHA mortgage. With a conventional mortgage, it's a little bit different, okay? And I'll explain why. So with a, let me try to wipe some of this away. With a, all right, so with the mortgage payment, you have a few different things, all right? So mortgage payment. All right, so with the mortgage payment, you have your principal and interest. So it's called P&I. All right, your principal and interest is going to be basically your loan amount and your interest rate and your term. That's what determines your principal and interest. So your principal and interest, let's say that's $700, okay? And then you have your taxes, okay? So you have your property taxes. Anytime you buy a home, you have to pay property taxes, okay? So your property taxes may be another $300 a month, okay? So $3,600 a year or $300 a month, all right? And then you have your insurance, okay? So you have your homeowner's insurance. You have homeowner's insurance, that may be an additional $100. All right, and then you have your private mortgage insurance. Private mortgage insurance on FHA mortgages are generally $68 for every $100,000 borrowed, okay? So if you do 68 times 2, what's that? 120, 170, so we're looking at what, 136? Yeah, so 136. So then we have PMI of 136. I think that's right. All right, so this is what you're considering when you're looking at a mortgage payment. That's why a lot of times those online calculators, when you're looking at Zillow or Mortgage, those things can't give you an accurate mortgage payment because they don't know what your credit score are. They don't know what your credit score is. They don't have all of the information from you to determine exactly what your mortgage payment is. And then they don't factor in this PMI number as well. So PMI is private mortgage insurance. It's called PMI on a conventional loan. It's called MI on an FHA loan. It's called a funding fee on a VA loan. But basically, it's an insurance policy that's taken out to basically cover if you were to default on your mortgage, okay? It doesn't help you. It protects the lender against the event that you don't make your mortgage payments and then we have to foreclose for that balance. So it's PMI. So the only way you can get out of paying PMI or private mortgage insurance or mortgage insurance is if you put down 20%, okay? So it's a risk-based assessment, okay? That's how we determine exactly what this amount is. On FHA loans, it's $68 per every 100,000. It's straight across the board as long as you qualify for an FHA loan. No matter if your credit score is a 620 or 720 or 840 or a 580 for that matter. If you get an FHA loan, then it's straight across the board. Conventional loans, it depends on how much you're putting down. It depends on the loan amount. It depends on your credit score. But on FHA loans, if you qualify, it's a flat percentage rate for everyone that qualifies. Okay, so this is what determines your loan amount. Okay, so when you're looking at a home that's $200,000, I would say in general you're going to be looking somewhere between $1,500 to $1,600 a month. So if you're trying to get a home and you're like, okay, I want to buy a home for, $100,000, then just assume that you're going to be paying $700 to $800 a month, unless the taxes are a lot more than, usual. But it's usually $700 to $800 a month. So for all intents and purposes, we're looking at a $200,000 home in this example. Okay, so a guy makes $5,000. His bills on his credit report are $1,000, and he wants to get a home for $200,000. All right. His max DTI is 50% or $2,500 because he makes $5,000 a month. So if we take this $2,500 and we subtract $1,000 away from it, that leaves us with a $1,500 expense ratio for our new housing payment. Now the mortgage payment is going to include several things. You're going to be looking at, your P&I, you're going to be looking at your taxes, your insurance, your hazard insurance that protects you in case your home burns down or something like that. And you're going to be looking at your private mortgage insurance. So these are the 4 things that you can't really get online when you're using a Zillow calculator or something like that. So this is what you need to look at. And just assume you're going to be, I would just say assume on the high end, $800 for every $100,000 borrowed. So that's what you need to be looking at. Now, as far as credit programs or loan programs, you need to have decent credit to purchase a house, unless you have a significant down payment. Okay, now I can finance an FHA loan to someone with a 560 FICO. Okay, but if you have a 560 FICO, just know you're going to be bringing in about 10% because you're going to be paying points. It's basically a subprime loan and it's a manual underwrite. So for an FHA loan, I can do a minimum of a 560 FICO, okay? So FICO scores, all right? So FHA 560. VA. I know it's 600. I need to double check. I might be able to do a little bit lower on VA loans. VA loans, these are the best loans in my opinion because it's 100% finance. So I've literally done VA purchases for people where they don't bring any money in. You have a 0% requirement on a VA loan. It's 100% finance. FHA loans, you have to put down 3.5% minimum. VA loans, you don't have to put anything down, okay? Now, you're going to have some separate closing costs and things like that, but sometimes you can increase the rate to finance those, or the seller may be willing to finance those for you, or give you a seller concession to cover those. Conventional loans. All right, conventional loans, I can do a conventional loan with the Home Ready program with a minimum of 3% down, so a little bit less than the FHA, but you need a 620 FICO. Okay, and then USDA, I think USDA is 640, I believe, but I need to double check on that. I haven't done a USDA loan in a long time, so I'm not as familiar with those. But 560, if you're at a 560, you're probably going to need about 10% down. If you're at a 640, then you're good. 3.5% down, 620, 3.5% down. Once you start getting below, that 620 number, then your closing costs are going to be a lot more. So your 3.5% down requirement from the program, and then you have your additional closing costs and stuff like that for taxes, insurance, escrow account. So you have other things that you have to take into account when you're buying a house. It's not just the government requirement for the loan program, but each property is going to have a different set of closing costs depending upon the taxes, your homeowner's insurance quote, title fees, interest, and your escrow account. So those things come into play. If you're at a 560, you're going to be putting down your 3.5% for FHA, but you're going to be paying points, and you're going to still have to cover, pretty much everything, unless you get a seller saying, okay, we're going to give you a 6% seller concession, so we'll cover 6% of your closing costs. So, but other than that, it's going to be 10%. Seller can cover some of it, but that's kind of unlikely these days, just because it's a seller's market. VA, it's 100% finance, so you don't need any down payment. Conventional, I can do a 3% down. USDA is 100% financed too, so you don't need any down payment on a USDA loan. You have closing costs, but you don't need a down payment. The down payments are required. The closing costs are not required to be covered by you. You can get the seller to cover them. If the seller won't cover them, well, now they're your expense. But this is how you determine exactly what loan amount you qualify for. You take your gross monthly income, you cut it in half, because you can do pretty much any type of loan nowadays with a 50% debt to income ratio. You figure out your debts by looking at your credit report, and then you take the monthly total of whatever you pay, the minimums on your credit report, and you divide that by your income. And then you look and see, okay, what type of house do I like? If I like a $200,000 house, $200,000 house for an FHA loan, all intents and purposes, is going to cost me, around $1,500, $1,600 a month. If the taxes are a lot more, if you're looking at an FHA loan and the taxes are, $5,000 a month for a $200,000 house, well, now that $1,600 number is going to jump somewhere in the 1700s. But that's how you do it. So if you have any questions, leave a comment or shoot me an email, or shoot me a direct message, or give me a call, 248-519-2117. You all have a great week. Bye.